mind, but also in our hearts. Hello! Good day, everyone!
I am Larombe.
I am Mitchaler.
I am Jacqueline Tanquison.
I am Anjelyn Delima.
And we are Group 7. This is International Financial Reporting Standards.
What are International Financial Reporting Standards? International Financial Reporting Standards are a set of accounting rules for the financial statement of public companies that are intended to make them consistent, transparent, and easily comparable around the world. This is our objectives. First is we have purpose of financial statements, which are often audited by government agencies, accountants, firms, etc. to ensure accuracy and for tax, financing, or investing purposes. Second is components of financial statements. There are 4 main financial statements. They are: first, balance sheets; second, income statements; third, cash flow statements; fourth is statement of shareholders' equity; third is overriding principle of fair presentation. Fair presentation requires the faithful representation of effects of transactions in accordance with definition and recognition criteria set out in the framework. 4 is accounting policies. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements.
Number 5. Basic principles and assumptions. As all financial transactions should be recorded in the same currency. Specific time period assumption. Financial reports should show result over a distinct period of time. Cost principle. The cost of an item doesn't change in financial reporting. Number 6. Structure and content of financial statement. Financial statement was a written record that conveyed the business activities and the financial performance of a company. Financial statements are often audited by government agency, accountant, firm, and etc. to ensure accuracy and for tax, financing, or investing purposes. Financial statements have 4 content, including balance sheet, income statement, cash flow statement, and state of shareholders. Number 7. Why IFRS is important? IFRS standard is important because it brings transparency by enhancing the international comparability and quality of financial information, enabling investors and others market participants to make informed economic decisions.
Understanding International Financial Reporting Standard IFRS 2 specify detail how companies must maintain their records and report their expenses and income. They were established to create a common accounting language that could be understood globally by investor, auditor, government, regulators, and other interested parties. The standards are designed to bring consistency to accounting, language, practice, and statement, and to help business and investors make educated financial analysis and decisions. They are some to take away International Financial Reporting Standard. IFRS were created to bring consistency and integrity to accounting standard and practiced regardless of the company or the country. They were issued by the London-based Accounting Standards Board IASB and address record keeping, account reporting, and other aspects of financial reporting. History of IFRS originated in the European Union with the intention of making business affairs and accounts accessible across the continent. It was quickly adopted as a common accounting language, although the US and some other countries did not use IFRS currently. 166 jurisdictions to making IFRS the most used set of standard globally. Who use IFRS? IFRS are required to be by public companies based in more than 160 countries, including all of the nations in the European Union as well as Canada, India, and Russia.
Standard IFRS requirements. IFRS covers a wide range of accounting activities. There are certain aspects of business practice for which IFRS set mandatory rules. First, statement of financial position. This is the balance sheet. IFRS influences the ways in which the components of balance sheet are reported. Number 2, statement of comprehensive income. This can take the form of one statement or separated into a profit and loss statement, and a statement of other income, including property and equipment. Number 3, statement of changes in equity, also known as a statement of retained earnings. This documents the company's changes in earnings or profit for the given financial period. Number 4, a statement of cash flows. This report summarizes the company's financial transaction in the given period, separating cash flow into operations, investing, and financing. In conversation with individual accountants, I am discovering an initial reluctance to accept the change to IFRS, which relies more on the accountant's judgment. IFRS requires that financial statements be prepared using four basic principles, which is clarity, relevance, reliability, and comparability. Principle of clarity requires that financial statements be easy to read and easy to understand. IFRS guidelines allow substantial discretion in deciding what information will be included and how it will be represented in the financial statements. The final decision rests with the accountant. IFRS simply requires that the result be a true and fair presentations of the company's financial position, its financial performance, and its cash flow. But this is not easy as it sounds. To achieve clarity, accountants should choose simplicity over complexity. You have to remember that the readers of these financial statements might not necessarily have an accounting background. The financial position of the company should be clear to anyone reading the statements. This is the real challenge of IFRS.
Again, I'm Hannah,
Jay and Jacqueline.
and Anjelyn.
Thank you for watching.